This term describes financial instruments which contain both a liability and an equity element. So under compound financial instruments, you have both things, an equity part and a liability part. The most common type of compound instrument is convertible debt. Convertible debt means that a bond which can be converted into shares. Like if I issue you some shares, and I'm sorry, I sold you a bond which you can return me back after 5 years. But I tell you that after 5 years, either you can come back and take your cash, or you can come back and claim the shares. You can convert your bond into equity shares. So it is called convertible debt. Do you understand? So having a bond, or having a simple bond, or having a convertible bond, convertible debt, which one is better for the investor point of view? From the investor point of view.
Sorry, sir. Can you please repeat, sir?
From the investor point of view, I have two options. I can give you a bond, or I can give you a convertible instrument, convertible bond, which can be converted into shares. The first thing is that on the face of it, it looks like that convertible bond is an attractive option, because investor will have this opportunity that end of 5 years, either he will take his 100,000, or he can buy it, or he can get the shares. And maybe at that time, the market price of the share is high, so he will be in a better position. So apparently, in principle, convertible bond gives more option to the investor, so it is an attractive thing. And therefore, because we are giving some additional benefit to the shareholder, therefore we give a lower coupon rate. Let's see one example. A company issued 3,000 convertible bonds. Let me see who wrote something on the chat. I can't see what is happening. Manage participants. And okay. So a company issued 3,000 convertible bonds at par on 1st January 2001. The bonds are redeemable 31st December 2004 at their par value. So how many years are passed? 2001, 2, 3, and 4. So 4 years. So now either you can return back the bond at par. At par means the face value, $100. Because sometimes redemption is also possible at premium. The bonds pay interest annually in arrears at an interest rate 8%. Each bond can be converted at the maturity date into $5 one shares. So what I'm offering you, $100 bond. After 5 years, you can come back and take back your $100, or I can give you 5 shares for each bond. The prevailing market interest rate for 4-year bonds that have no right of conversion is 8%. Now, this is what Ankit was focusing at, that convertible bonds usually have a lower coupon rate, because in market, the normal interest rate is 8%, but we are going to pay only 5%. Why we are paying a lower interest rate? Because we are giving you an option for conversion. So if you have an option for conversion, it is an additional advantage for you, and therefore the company is giving a lower interest rate, which is called coupon rate. The present value of 8% at $1 receivable at year end is these. So these, they have already given you the discounted values. I'm sure you know the process of discounting, right?
Sir, can we do the discounting by this example, like how they have calculated this value?
0.926?
Yeah. How
do they calculate 0.926, right?
Yes.
Okay, so I'll show you. I'll show you in a minute. We come here. Actually, your formula is future value. When you do compounding, compounding is finding the future value. Compounding means finding the future value of present cash flow. So formula is future value is equal to present value multiplied by 1 plus I, the interest rate, and power n. This is called compounding. Compounding means that you are finding the future value. You know, you are here. Let me write down here. So what you are doing in compounding, let me put these lines here. So this is the process of compounding, and this is your formula for compounding, where you are finding the future value. So you've got some money here, and you want to find out that how much this will be after a certain period of time. This is called compounding. And discounting is finding the present value of future cash flow. And the formula is present value is equal to future value divided by 1 plus I power n. It's the same thing, just I'm changing the places. The same formula, you just rearrange it. And actually, this is the process which is called discounting. Discounting process is opposite. So in discounting, this is the formula. So what happens that you've got some number here that you will have 5,000 at the end of 5 years.
Can we do this with the same example?
I'm going to do it. I'm going to do it. I know that where you are coming from, and I will resolve all the queries in your mind. I've just started, and that's why I moved to Excel, because I'm going to explain it in very detail. So if I tell you that in year 5, which means that in year 2024 you will get 5,000, you know that this 5,000 you will get in year 2024, 5 years from today, and you are very much interested that if I get it in 2024, how much of this money is it in 2019? Okay, you want to find out the present value of this, that how much 5,000 will be in 2019. You know that it will be little less. You know that it will not be 5,000, but how much it will be, you have to find out. That is called your, how to say, discounting. So let's suppose that here you've got year 1, year 2, year 3, year 4, and year 5, and you have to receive some amount, say, I don't know, $100. Yeah, $100 you will receive every year. Every year you will receive $100. But the $100 in year 5, or $100 in year 4, or $100 in year 3, they are not equal to your $100 today. This is your today, 0. So you have to discount it. So you need to find out a discount factor. Let's suppose that we are discounting it at 10%. Let's suppose that we discount it at 10%, and our factor is 1 divided by 1 plus I power n. Please allow me to write down this. See, this is what I wrote. Can I write down like this, that present value is equal to future value multiplied by 1 divided by 1 plus I power n? Is it the same thing?
No, sir.
It is same.
So yeah, it is same.
These two are same, right? I mean, you can write down 3 divided by 2. I'm sorry, this is, you can write down 3 divided by 2. 3 divided by
Add, so you can add a comma.
okay, you can do 3 divided by 2, or you can say like 3 multiplied by 1 divided by 2, right? It's the same thing.
Yes, yes.
So this is I'm doing. So this is my factor. So now I'm going to write down 1 divided by 1 plus this interest rate, and I will say power this year 1. So this is my 10% discount factor for year 1. And if I have to, now I'll just make some, I will lock this cell so that I can copy paste it. So these are the discount factors for the next periods. If I have to find out the present value, I multiply this with this and I get these numbers. So it means that $100 after 5 years are equal to $62 of today, which means that if your inflation rate or if your discount rate or if your cost of capital is 10%, keeping in mind it is 10%, $100 after 5 years is equal to $62 of today, which means that whatever you can purchase in $62 today, the same thing you can buy in $100 after 5 years. In our question, they were doing it at 8%, right?
8%.
So I put it at 8%. Let me show you. Let me share with you. What did they calculate? 926, 8577, 94735. I'm not sure if they are taking exact numbers or they are taking hypothetical numbers. What were the values?
Same.
Huh? Same values?
Same values.
Okay. Now you can see these numbers. You can find out these discount tables at the back of your book. You can make these table by yourself. Let me write down. Let me make a table. We can make a table. Let's go to here. Do you see my now this browser?
Yes, sir. I can.
Okay. So let me go to Google. Oh, my browser has gone. Where it is gone? You see? Okay. Let me write down. Present value tables. I go down here and let me open one table. Let's suppose I open up at 10%. Do you see these values at 10%? Yes. This is the column for 10%.
Yes, sir.
So year 1, year 2, year 3, year 4, year 5 until values for year 1. Emmanuel, can you see the values?
I can see, sir.
So you see these numbers. Where did they get these numbers? Can you make this table yourself in Excel?
Yes, sir.
You are just saw it. Now I ask you one question. This is one number which says 0.350. What does that mean? This 0.350, is it 3.50 dollars, kilograms, liters, miles, centimeters, meters? What is this thing?
This 3.50 is a discounting factor.
No, it's discount factor. It's a very technical term. Tell me a very simple word. I'm a layman.
It's a present value for $1.
Okay.
At the rate of 10% in 11 years time.
Okay. Can I say like this, that if
Yes, sir.
so if you have $100,000 today and you do not invest it, your $100,000 will become $14,900 in 20 years. Please do take care of your money. It is losing value. Not only you are getting old, your money is also getting weak.
Yes, sir.
Scared?
No, sir.
I'm scared, sir.
You are scared. You should not be scared. You already have passed. You already passed F9. Why are you scared?
No. I scared in the sense that if I have money, I need to invest. Otherwise, time value of money is going to eat all my money.
Yes. So we just know that how to calculate these values. You can make these factor tables. You don't need to do these factors just by the book. You can do it even on your calculator. You can. Okay. So it says that the present value. Now, can you see the Excel slide?
No,
Yes,
just the presentation.
No, PowerPoint. Sorry, PowerPoint. I shared the PowerPoint.
I can see the PowerPoint.
Okay. So it says that the present value of 8% of $1 receivable at end of year. Even on your calculator you can do it. Okay. So it says that the present value. Now, can you see the Excel slide?
No,
Yes,
we are
sir.
the presentation.
No, PowerPoint. Sorry, PowerPoint. I shared the PowerPoint.
I can see the PowerPoint.
Okay. So it says that the present value of 8% of $1 receivable at end of year 1 is 0.926, 0.857, 0.794, 0.735, and so on. So what do we need to do? Now, remember that we are talking about a compound instrument. We are talking about a convertible debt. Our coupon rate is 5%, whereas the market rate for similar debt is 8%. Life is 5 years. After 5 years, the holder of that instrument has a right to convert into 5 shares, or he can take back his cash. Okay, this is the scenario. Required. Show the accounting treatment of the bond at inception and the financial liability component at 31st December 2001. You issued on 1st January 2001. So first you have to show the bond at inception at the beginning, and then you have to show how much liability do you have on 31st December 2001 using amortized cost. What is amortized cost? I will show you now. So at 1st January, which means at the beginning, financial My non-current liabilities are, so how much you issued actually? 3,000 convertible. Okay. For 100 each. So how much cash did you get? 300,000?
300,000.
But your liability is not 300,000. Liability we have to calculate. How do you calculate your liability? I show you. Now, when you, your liability is what you promised. What you promised? You know what we promised here? Let me go back. Let me go back, please. I'm sorry. I have to go and make it an Excel. Listen. Do you see Excel?
Yes, sir.
So what we said to them, we told them that if we are issuing this bond, let me delete this thing and let me delete this thing. We receive here 300,000. This is the cash which we received. And how did we get it? We get it 3,000 multiplied by 100. And then we told them that we are going to pay them 5% interest, right? 5% interest. So how much is 5%? 300,000 into 0.05. I will pay 15,000 here and 15,000 for the next 5 years. 1, 2, 3, 4, and 5, right? This is my promise. And also I have to pay this 300,000 here, right? Back.
Yes, sir.
Am I right or wrong?
No, sir, right.
So it means that let's make here, we've got here, is this 4-year bond or 5-year bond? I think 4-year bond.
4-year bond.
4-year bond. So let's remove this one. So it means that here we have to pay 15,000 and 15,000, 15,000. And how much do we have to pay in the 4th year? 4th year we have to pay 315,000, right? Am I putting numbers correct or not?
Yes, sir.
So this is your liability because I promised them, I put 300,000, but I do not promise to give 300,000 today. I say I will give you 5%, which means 15,000, 15,000, 15,000, 15,000 for the next 4 years. And on the 4th year, at the end of 4th year, I will give you back your 300,000 also. So these are my cash outflows. So when I discount them at 8%, this is what I have to pay. The present value of my liability, I'm saying that the present value of my liability is 270,191, right? So I receive cash, debit cash or bank, which is 300,000, and I have liability. I'm recording at present values. My liability is 271.91. So it is not balancing. What is happening? Where is the remaining amount? Emmanuel, you just passed F9 here. Credit equity. Are you people there?
Yes, sir.
So actually, I'm issuing the bond. I'm also getting some benefit out of that. I don't issue bonds for the sake of fun. I issue bonds for the sake of some, material benefit. So when I took 300,000, and I promised to pay them 5% or 8%, whatever it is. So, are you clear here? Emmanuel, I'm not listening from you. Emmanuel, Ankit, are you clear?
Yeah, I'm just wondering, sir. So we have calculated the discounted.
Yes. I'm going to speak that. Your payment of interest is done at 5%, and your discounting is done
at 8%.
At 8%. This is something I have to speak, but I just wanted to make sure that you understand it here, and then I'll go there. That's the next point to explain. So I took 300K, and then I promised to make these payments, and the present value of these payments, when discounted at 8% for me, is 270. So I say that my liability as of today is 271.91, and the difference between these two goes to my equity. This is my benefit for issuing the shares. I receive this much and I pay back this much. Okay, now comes back here. Because the bond says it is 5%, so I will say that 300,000 into 5% is 15,000. But I will discount them at my normal, effective interest rate. You call it effective interest rate. Are we clear here?
Yes, sir. Can we do the accounting, sir? Year 1, 2, 3, 4.
Oh, I will do it. I would love to do it. Yeah, I would love to do it. So this is your 01/01/2001, right?
Yes, sir.
And let me call it bond liability. Okay. Then what will happen? Now you know that you have to pay.
So why are we taking this balance to equity?
That's my gain. That's my profit. That's my benefit. I'm not doing it for fun. If I take from you 300,000 and I give you 300,000, why do I do that? You get 5% on whatever profit. I also need to make something. Yeah.
Okay.
So, sir, we cannot credit P&L on day 1.
No. It's not operating profit. In P&L, you're taking your operating profits.
Okay.
Are we clear here?
Yes, sir.
Okay. Now there is a concept which is called amortized cost. One thing I must tell you, you have to pay $300,000 at the end of year 4, right? This is what you have to pay. But your liability today, it stands in your book as only 270,000. If you have a liability of 270,000, how will you pay 300,000? You never make payment more than your liability. Whatever you see in your balance sheet as your liability, you only pay that. You pay your liabilities, right? My balance sheet shows a liability of only 270,000. How can I pay 300,000? I cannot. So what I need to do, I need to inflate it. You call it unwinding. I'm going to unwind it. How do I do that? Now there is a concept of amortized cost. And that's a very important concept. It is the strongest pillar of understanding your IFRS 9 or financial instrument. You cannot handle or manage financial instrument if you do not understand amortized cost. Now let me show you how it works. You've got year 1, 2, 3, 4 years. So how much is your opening liability? Your opening liability in year 1 is 270,191. And you discounted it at 8%. Your effective interest rate was 8%. So here you say 270 multiplied by 8%. This is the interest rate at which you discounted it. Now, there are two things. First, we discounted it. Now we are going to compound it. Now we are reversing the process. I decreased the value by 8%. You see, I divided them by 8%. How did I get this number? I divided by 8%. Now I'm going to multiply by 8% so that I go back to balance. I multiply with 8% by effective rate. And then I have my coupon rate. Coupon rate was 5%. So 15,000 I'm giving them. How much interest you pay every year? Listen, my opening liability is this. My effective interest rate liability becomes 21, but 15,000 I pay back. I paid them 15,000. I do not keep it. So this is the value at the end of the year. Next year, my opening liability will become 276. And let me block it. Let me complete the figures. I know that you guys have not fully understood it. I will explain it again. Let me complete the figures and I will show you what I did. Now, what do you see here? End of 4 year, you will have 300,000 in your books as a liability. So what happened in year 1? You said that my liability is 270. I should have paid at 8%. I should have paid at 8% because I discounted at 8%, but I'm paying 5%. So this is the interest I should have paid. This is the interest I am paying. So therefore it is increasing. Your liability is increasing. Next year on 276, you charge 8%, which is your interest should have been 22,000, but you kept paying 15,000 every year. And therefore your liability is increasing. These are called your amortized cost. And this is what you show in balance sheet. Now, how do we do its treatment? Where are our double entries? So this is my double entry for, let me put it here. When I issued, I made this thing. My bond liability was like this. On 31st of December 2001, which means end of the year, I will say debit finance cost. How much is the finance cost?
15,000.
No, 21,615. This goes to my income statement. And I say credit bond liability, which is 21,615. And then on the same day, I say debit bond liability with 15,000. And I say credit cash or bank 15,000. I pay them 15,000. So that's how my liability decreases. I first credit it because this is my credit. So this is my liability increases. So you've got your bond liability here. Now your bond liability becomes 27,191 plus 21,615. And then on the same day, you pay 15,000. So your bond liability decreases by 15,000. And you make a total of these three numbers. It gives you 277. This is the same number as you get here, like here and here. This goes to the income statement, 21,000. And your finance cost should have been 21,000, but you paid 15,000 only. Remaining is added into the principal liability. And that's how your liability is increasing. In 4 years, it will be shown as 300,000. Ankit.
Yes, sir.
Now ask me what you do not understand. And next year you will again follow the same thing. The two double entries, 22,144 will go to the finance cost, 15,000 you will pay, and your liability will become 283 and so on.
So why are we using two rates? One for interest and one for discounting.
Okay. The investor, I have promised to give you 5%. He only knows 5%. He does not know any other thing. But for me, if I had gone to the bank or somewhere else, I would have got the money at 8%. This is the effective interest rate. This is the market rate. I'm giving him for 5%. For him, it is 5%. For me, the cost of capital was 8%. You did it in your F9. Your internal cost of capital was 8%. If you had taken it from the bank or somewhere else, they would have given you at 8%. Because you are giving them at a convertible bond, you are offering them a lower rate. So 5% is for them. For you, because why I did for 8%? Because I also discounted at 8%. How did you discount? You discounted 8%. Your discount factor is 8%. So I told you that when you used your present values, you were, what you were doing, you discounting them. First you discounted them, and now you are going to compound it back to the same amount. So when you brought it back, when you did your discounting thing, your discount rate was 8%. Here I did at 8%. And therefore, I am compounding it back at 8%. This is my effective interest rate. Effective interest rate means the interest rate which will make this 270 equal to 300,000. This is the interest rate which I used in discounting, and I'm going to use it same in compounding.
Okay.
Because that is my internal rate. 5% is something on which you calculate the number of dollars which I gave him, like $15,000. 5% we are not using for discounting or compounding. 5% is to calculate how much we have to give them. Like 5% of 300,000 is 15,000. But discounting and compounding will be done on your effective interest rate.
Meaning our cost of capital.
Which is your cost of capital. Exactly. Your cost of capital may be different than what profit you are offering. My investors do not know my cost of capital. If I give them, for example, my cost of capital is 8%. I cannot give them at 9%. It has to be less. Otherwise, I will be in loss.